This is our discussion of Chapter 24. So here in the outline, we see that Chapter 24 is about completing the audit. So we're right at the end. Let's say, for example, that fiscal year end was December 31st, and we are completing the audit as of March 1st. So we're right at that date. So the functions we discussed, again, are performed at or near the end of field work. There's a little chart illustrating the functions. I will be going over those here in the handout itself. So we'll see several different functions and what we need to do there. First thing is to perform some additional tests for presentation and disclosure. Now, here we're looking at footnote disclosure, parenthetical disclosure, etc. So many of these tests were integrated with tests for transaction-related and balance-related audit objectives. So additional tests could be conducted. Have a look at them on page 767. I'm not too terribly worried about those. Same thing for B. There are 4 presentation disclosure audit objectives. We've seen them previously. Some examples of procedures to fulfill each. Again, just glance at. I'm not that worried about it. I do want you to know about C. The completeness objective can be especially troublesome when it comes to presentation and disclosure. That's because we may never know what has been left out of it. So what has been left out of it means the completeness was not fulfilled. So reading on, this is because the client may not disclose all necessary footnote and parenthetical information in the financials. And we have to search for it. That can be something where we don't detect everything. So this can occur in many areas, but often, very often in fact, occurs for the client's contingent liabilities because they don't like to admit to them, as well as to various contracts the client may have. So speaking of contingent liabilities, we look at Roman numeral 3 and reviewing for contingent liabilities here. So a contingent liability is different than an actual liability, such as an account payable. So a contingent liability, we may not know for certain the amount which may be paid. And second, we may not know for certain that it will become an actual liability. A very good example is if we're being sued in court and the case is still pending. We don't know how much we may lose, and we don't even know that we will lose the lawsuit. So we do know from financial accounting if it is probable the client will lose, and we can reasonably estimate the amount of the loss we will accrue it. If it's only reasonably possible that the client may lose, and or if we cannot reasonably estimate the amount of loss, we will only disclose the contingent liability. So in A, this partly ties into our period liability tests. If we covered Chapter 18, they would be in there. Thus, many contingent liabilities may have been found here. So an out-of-period liability test would mean during field work. So outside the period being audited, such as in our case, from January 1st through March 1st, because those are the dates of field work. So now period liability test, we would look at things such as cash payments that the client has made. So that payment may be to sell up a contingent liability. Well, in B, though, there are some additional tests here to perform. One thing is we will inquire about additional contingent liabilities, and that should be documented in the letter of representation. We'll see that a little bit later, also known as the client representation letter or management representation letter. But management must say to us there are no other contingent liabilities because, after all, accounting is up to them in the end. It is management's responsibility. If they happen to know of an additional contingent liability, but they did not document that to us, they're in trouble now. Then number 2, we will review minutes of stockholder and board of director meetings because they discuss big things there, such as in Chapter 8, when the board of directors was discussing an ongoing dispute with the IRS. That could be a contingent liability. Something else we will do is to review dealings with legal counsel. And one good procedure is to simply examine the legal expense account to determine the reason for each expense. So why did you go to the lawyer each time? Good way to find stuff. And the auditor should also inquire with the attorney, the client's attorney, about existing and pending litigation, and there's an example of an inquiry on page 772. Look at it briefly when you have a chance. I will not test you on this. So just get a little idea of what this is. But this request and opinion is to the probable outcome, damages, and existing and potential legal problems up to the audit report date. In our case, March 1st. And attorneys are sometimes reluctant to reply because they may feel that they will compromise cases. So maybe they will lose as a result of this. However, if they refuse to comment on information which is within their purview, this constitutes a scope limitation and can cause the audit report to be modified. So if the attorney doesn't want to say anything, generally the client gets on the phone with them and they will get an answer. Otherwise, we have a scope limitation. We can note this inquiry is non-biased because the auditor may have to contact an independent attorney to obtain a second opinion, because client's attorney is certainly biased and is more likely to cast things in a favorable view. Then number 4, we should also review the provision for any income taxes and also any revenue agent reports, because there could be some contingent liabilities there. They may owe the IRS or State Department of Revenue. Then review lines or letters of credit, like a home equity line of credit on a personal level, and confirm these. Then number 6, review commitments such as for purchases, pension plans, profit sharing plans, warranties, because all these are possible contingent liabilities, such as a pension plan, that's contingent, quite frankly, upon the retiree living. A warranty, we remember from financial accounting that we accrue warranty expense in the year of sale for future warranty service. So we will debit warranty expense and credit a type of liability, which is actually a contingent liability for warranty service in the future. And that is contingent upon the purchase breaking down. Then, number 7, we will also review transactions after fiscal year end, just looking to see if anything happened. And we'll be aware of news items that affect clients. You can search for them, and we should certainly make sure that those are reflected in the financial statements. Then, section number 4, to review for subsequent events. So these are events which occur between fiscal year end and the audit report date. In our case, between December 31st and March 1st. So occurring then, and they materially affect the financials. So these are things which happen in January and February and March 1st, but they affect the previous year's financials, such as if there is a major customer, the client, who goes bankrupt during this time. Well, if their receivable as of 12/31 has not yet been paid, it may have to be written off. That's a very good example of the subsequent event. Well, since the audit report is given on the audit report date, the auditor must be able to assert that the financials are fairly stated based on all evidence he or she could have known at that date. And this implies that the auditor must actively search for subsequent events up through the audit report date. So a subsequent event may require one of two things. It may require adjustment. In other words, a change of dollar amounts to the financials. That would be if it relates to a condition which existed at fiscal year end and therefore provides more information about the financials. So having to go back and write off that receivable as of 12/31 is an adjustment. But the other thing may be disclosure but no adjustment. So the subsequent event may relate to a condition which existed at fiscal year end but required no adjustment. So just more information. On the other hand, it may relate to a condition which developed after fiscal year end. So let's say that for that customer, the client who declared bankruptcy in January or February, there had been no account receivable as of 12/31. Instead, there was a receivable from a purchase in January. Well, the previous year's financial statements require no adjustment, but if that receivable is big, even though it occurred in January and did not exist December 31st, Well, financial statement readers will want to know about this. So we need to make sure the footnote is added. Now, in C, let's bear in mind that even though the audit report date is March 1st, it takes some time to publish the financials, publish the audit report, and get those out in the hands of investors. Let's say that occurs at the end of March, March 31st. So we have March there kind of in limbo. So during this time, let's think about what happens in C if a major event is discovered. It's after the audit report date, March 1st, is before the report is issued on March 31st. Well, the auditor should treat it as a subsequent event, sort of like stop press. And the auditor has two options in dating the report. First of all, he or she may audit only the subsequent event and dual date the report. That's the most common thing to do. So the report would be dated March 1st, except for footnote 13, let's say, which is dated March 15th. Now, the other option is to extend the search for subsequent events to this later date and single date the report. Has not done as much because obviously that's more costly. And audit procedures which can uncover subsequent events include inquiry, reviewing dealings with legal counsel, examining minutes of stockholder and board of director meetings, reviewing any interim financial statements after a fiscal year end, such as if they did some financial statements, the client that is, for January, we can review them. Then also just reviewing transactions after fiscal year end and obtaining the letter of representation, which we'll see in a couple of minutes. And E, we can note the subsequent events were events which were uncovered before the financials were released. But if a similar event is uncovered after the financials are released, it's termed subsequent discovery of fact and indicates the financials were either misstated or they lacked adequate disclosure. Note it is therefore about a condition which existed before fiscal year end, and it has to be something very big. And the auditor will take action if it can be construed that he or she should have known about the fact at the audit report date or financial statement issuance if it's an unusually significant fact. By the way, one of the most common subsequent discoveries of fact is to discover fraud in the financial statements. So obviously, we're talking about something big here, not something run-of-the-mill. So if possible, the best solution is to recall the financials, correct them, and reissue them. That's happened in every case of fraud unless the client went under. They had to clean up their financial statements and get another audit. Well, number two, the client should inform regulatory agencies and stockholders. But if the client refuses, the auditor should inform the board of directors. And if the board of directors still refuses, the auditor must inform regulatory agencies like the SEC. It's one of the few cases in auditing where we can be a whistleblower. Then third, subsequent discovery of fact differs from subsequent events in that no active search is required. What the standards say is, however, if the auditor becomes aware of it, he or she must act accordingly. So obviously, practicality, we will search. Then the next section here about final evidence accumulation to wrap up any loose ends. We will do some final analytical procedures just to make sure things are still on track. Then we will evaluate the going concern assumption once again, making sure that we think the client will still be in business for the foreseeable future. Analytical procedures help here because if we see the financial health is declining, such as a lower current ratio, we could have trouble. And the auditor is to consider whether the client has the ability to continue as a going concern for 1 year after a fiscal year end. We saw this back in Chapter 3, and we saw that if there is substantial doubt that the client can continue as a going concern, we have to bring this out in the audit report by adding a paragraph. So we're very concerned about that here, because after all, during this time of field work, the client's financial health could have declined. Then C, we will also obtain the letter of representation from management. It's dated as of the audit report date, and it's designed to document responses from the client as well as to impress upon the client their responsibility for the assertions in the financials. After all, they are responsible for those financial statements in the end. and also helps to delineate management's responsibilities as opposed to the auditor's responsibilities. And there's a list of items to include in a minimum on pages 778 and 779. So if you would please read those bullet points, and they're quite easy. We can note that this rep letter is not objective and thus must be corroborated by more reliable evidence. Because after all, this is coming from the client is not objective. So in no way does this relieve our evidence gathering responsibilities. But however, the auditor is faced with the potential scope limitation if management does not provide full disclosure in the rep letter. So management does need to come clean, or they will raise suspicions. So they would certainly have trouble then. By the way, those things to include in the rep letter, on page 778, you'll see them starting at the bottom, and they go through about the top third of page 779. Then D, we should also read other information in the client's annual report to make sure it's consistent with the financials, such as management's discussion and analysis of the financial statements. It's a required thing that management must write up. We'll see more about it in the next auditing course. But it's a narrative view of things through management's eyes. So if there's something, for example, in this discussion and analysis of the financial statements that does not jibe with financials, well, we need to make sure that this other information is cleared up so that it's accurate. Then, Roman numeral 6, overall audit results evaluation. It's normally done by the partner in charge of the engagement, so high up. One thing is the evidence sufficient? And firms often use a checklist. You can glance at what's on page 782. I will not test you on it. Then, there should also be a final working paper review. Well, working papers are normally reviewed at each level of the audit team during field work, but there should now be a final review at the partnership level, just to get any remaining bugs out. Then, in C, we will form the audit opinion and make sure the evidence agrees with it. And we can note that part of this involves determining whether the sum of the past or immaterial audit adjustments is material. We say past audit adjustments because we passed up taking action on them when we found them because they were immaterial individually. We should still keep track of them because total amount might just be material. So that's why I say back here in the notes, the past audit adjustments should be entered on a worksheet during field work, so keep track of each one. And both the auditor and management must agree that past audit adjustments are immaterial, both individually and in the aggregate. For example, at Florida Southern, in my service on the audit committee, we will be presented with a list of audit adjustments they found, and there are never many. But we as an audit committee must agree that individually, these adjustments are immaterial and that the total amount of them is also immaterial. That makes sense because management is responsible for the financial statements. And there in parentheses, by the way, for audit adjustments which were individually material, the trial balance should be adjusted when discovered. However, you still notify clients of past audit adjustments so they can make them after the audit is complete. This also helps prevent these relatively small errors from compounding in the future, because they tend to get bigger, so the client should think about root cause analysis and hopefully address the root cause, clear up any small things now so that they don't become larger in the future. And there may also be a financial statement disclosure checklist to ensure that disclosure is adequate. Not too concerned about that. It's on page 784 if you'd like to have a glance at it. I would, though, like to take a look at the past audit adjustments. So here in figure 24.6 on page 783, we see the same thing. It is called unadjusted misstatement audit schedule. It comes from PPC software, I can tell. And up here we see it's Windows-based. And then down here, we would fill in the template the PPC would have for us, where we list the audit adjustments that we found and some information about them. such as understated allowance for uncollectible accounts. The client didn't have it as big as it should be, $95,000, individually immaterial. Then there were some accounts receivable sales call-off misstatements. We will see those in the next auditing course. But basically, they placed the transaction in the wrong year. It occurred right around fiscal year end. $60,000 of those. That would be such as a sale for the year 2020, which was accidentally recorded in 2021. It would have been late 2020. It would be recorded in early 2021. That would be a cutoff error. Then the account inventory, there was a difference between the physical inventory and book values of $120,000. They found some unrecorded liabilities. I'm sure that kind of made the auditor nervous, but total amount of $285,000. And then some repair expense items that should have been capitalized. Well, those are things such as a new engine in a vehicle, a capital repair, but instead, this company charged that off to repair expense. They should have capitalized that as an asset, $90,000. So the auditor has some conclusions here at the bottom. So the auditor says the net effects of the above items are as follows. We see the net effects, we see materiality, how much tolerable misstatement they will take. We see that all these net effects are way less than the amount of materiality that they will accept. And we see the conclusion over here, which every good working paper should have. None of these aggregate effects or the individual items has a material effect on the financial statements in total or with respect to the components they pertain to. On this basis, adjustment of any or all the items is passed. So we can give the client a clean opinion and they don't need to fix these errors. But again, we will present these misstatements to the client. We will have, preferably the board of directors agree that these are immaterial, both individually and in total. So as long as they feel that way, that's good. And again, we will tell them that you should really correct the root cause of these because this year you got lucky. Next year, these may become bigger and you won't be so lucky. Then there is also a concurring partner review. And that's a review by an independent partner, generally one with quite a bit of experience, just to make sure that everything's in order. Then, communication of audit results with senior management and the board of directors or a similar group charged with governance like a board of trustees of Florida Southern. And then the auditor normally writes an exit memo and conducts an exit conference with the client at this time. Our auditors do. They have an exit memo in which they go over the audit results, and they do meet with us. So they have the exit conference, and again, as a part of that, they will look at the past audit adjustments and have us agree that they're immaterial. So here are some things we must communicate. Any illegal acts or fraud. Also, any significant deficiencies and material weaknesses regarding internal control, because all those things are very important. Then there are some other items to report under the SASs, under the Sarbanes-Oxley Act. Take a look at page 76 when you have a chance, just a few things there, and that will suffice. Then B, something called the management letter. It's optional for the auditor to write, but it's a good business practice. And the purpose is, is to help the client improve the efficiency and effectiveness of its operations. It does not address the standard audit results. It differs from the letter of representation. So the management letter just contains suggestions for improvement. It can help the client feel as though they've gotten some value out of the audit. So let me clarify this in that the management letter is optional. It is written from the auditor to the client. Sometimes people confuse that with a letter of representation, which the client writes. The letter of representation is required. It is written from the client to the auditor. So just don't get that confused with the management letter. And that ends chapter 24. Please let me know if you have any questions about it.